December 30th, 2025. A leaked internal conference call from BlackRock, the world's largest asset manager controlling over $10 trillion, just revealed something explosive. They're positioning for gold to hit $40,200 per ounce by the end of 2026. Current price? Around $3,900. That's a 58% gain from where gold was trading just 6 months ago. But here's the terrifying part. This wasn't a public announcement. This was an internal positioning call, meaning they're accumulating now before telling you. When the world's most powerful financial institution panics into gold, you better pay attention. Welcome back. I'm John, and I track what Wall Street does, not what they say, but what they actually do with their money. Over the next 14 minutes, I'm going to break down exactly what this leaked BlackRock call reveals, why they're positioning for $200 gold, and how you can position yourself before the crowd catches on. If you want the real story behind institutional money flows, subscribe and hit notifications. Because by the time this hits mainstream news, it'll be too late. Let's expose what BlackRock doesn't want you to know yet. First, let's understand who BlackRock is and why their positioning matters more than any talking head on CNBC. BlackRock manages over $10 trillion in assets. To put that in perspective, that's larger than the GDP of every country on Earth except the United States and China. They control the iShares Gold Trust ticker symbol IAU, one of the 2 largest gold ETFs in the world, holding over 483 tons of physical gold as of November 2025. When BlackRock moves, markets move. Here's how institutional positioning works. They accumulate first, announce later. You see, when BlackRock decides to massively increase gold exposure, they can't just announce it publicly and then buy. Why? Because the price would spike before they finish accumulating. Instead, they quietly build positions over weeks or months. Then they release public commentary, analyst reports, and upgrade recommendations. By the time retail investors see the headlines, institutions are already sitting on 20-30% gains. Now, emergency internal calls like this one, those are rare. These happen when management sees something so significant, so urgent, that they need to reposition portfolios immediately. The last time BlackRock had positioning calls like this, March 2020, right before gold rallied from $1,600 to $2,160 in 6 months. And late 2007, before the subprime crisis, sent gold from $800 to $1,900 over the next 4 years. So, when a leaked call reveals they're targeting $4,200 gold by end of 2026, that's not speculation. That's institutional front-running in action. Let's talk about something Wall Street desperately doesn't want you to understand: the 2-tier information system. While you're reading Yahoo Finance headlines and watching CNBC analysts debate whether gold is overbought, BlackRock is on private conference calls repositioning billions of dollars. Here's how the game works. Step 1. Institutions identify opportunity through internal research, geopolitical intelligence, and central bank data. Step 2. They accumulate positions quietly over several weeks using dark pools and off-exchange transactions. Step 3. After they're positioned, they release public research reports and analyst upgrades. Step 4. Retail investors flood in, driving the price higher, and institutions sell into that demand at peak prices. You're not getting the information at the same time. You're getting it last. According to SEC filings, we can track BlackRock's gold ETF holdings, but those reports come out 45 days after the end of each quarter. So right now, in early January 2026, the latest filing we have is from mid-November 2025. That's a 6-week information gap. What has BlackRock been accumulating during that blackout period? We don't know yet. But if history repeats, we'll see massive inflows reported in their next 13F filing. And by then, gold will already be $500 higher. The leaked call is your early warning. The official announcement will be your exit liquidity. Now let's dissect what was actually said on this leaked BlackRock call. According to sources who attended the meeting, BlackRock's commodities team laid out 3 primary drivers for their $4,200 gold target. Number 1, central bank buying acceleration. They cited the World Gold Council data showing 634 tons of official sector purchases through September 2025, with Q4 expected to push the full year total above 1,000 tons for the first time ever. Poland bought 67 tons. China's officially reporting minimal purchases, but BlackRock's internal intelligence suggests off-book accumulation through Hong Kong and Swiss refineries. Number 2, currency debasement and Fed policy shift. The call specifically mentioned expecting the Federal Reserve to cut rates at least 3 more times in 2026, bringing the target rate down toward 3.5 to 4%. According to BlackRock's models, every 50 basis points of rate cuts historically adds $150 to $200 per ounce to gold prices due to reduced opportunity cost and dollar weakness. Number 3, geopolitical risk premium. They didn't get specific on which flashpoints, but the call referenced multiple simultaneous crisis zones. Likely Ukraine escalation, Middle East tensions, and Taiwan Strait concerns. Their quantitative model assigns a $200-$400 risk premium to gold when global conflict probabilities exceed certain thresholds. We're apparently at that threshold now. Here's where it gets interesting. BlackRock's public gold price forecast, the one they published in their official 2026 outlook, calls for $3,800 to $4,000. But the internal call discussed $4,200 as the base case, with upside scenarios reaching $4,800 to $5,000 if central bank buying or geopolitical tensions exceed expectations. Why the discrepancy? Because they don't want competition while they're still accumulating. And the data backs this up. According to the World Gold Council's November 2025 report, global gold ETFs recorded their strongest year ever for inflows, with holdings rising to 3,132 tons, the highest month-end value in history. BlackRock's IAU alone has added significant tonnage. Exact figures won't be public until late January, but industry sources estimate 15-20 tons of inflows in Q4 2025. History is screaming at us because this isn't the first time BlackRock has positioned ahead of major gold moves. 2008. In early 2008, before the subprime crisis went mainstream, BlackRock internally upgraded gold allocation recommendations from 3% to 8 to 10% of portfolios. Public announcement didn't come until September 2008, after Lehman collapsed. Result? Gold rallied from $800 to $900 over the next 3 years. Institutions bought at $800. Retail chased at $100 to $400. 2020, March 2020, COVID panic. Gold was $1,600. BlackRock had emergency liquidity calls where they recommended buying gold and gold miners aggressively. Public recommendation didn't come until May 2020. Result? Gold hit $2,060 by August, a $460 rally in 5 months. Once again, institutions positioned early. 2025. Now we're here. Gold has already rallied from $2,000 to $3,900. And BlackRock is saying there's another $300, $800 left. The pattern is consistent. Emergency internal positioning calls precede 6 to 18-month rallies of 30 and 60%. If the pattern holds, and BlackRock is positioning now for $4,200, $4,800 gold, we're in the accumulation phase. The explosion phase comes later. So why is BlackRock so confident gold hits $4,200? Let me give you their 4 key signals. Signal number 1, central bank buying acceleration. The World Gold Council confirmed central banks bought 220 tons in Q3 2025 alone, 28% higher than Q2. Year to date through September, 634 tons. But here's what BlackRock knows that the public does not. China is buying massively off the books. How do we know? Swiss refinery data shows huge gold flows to Hong Kong and mainland China, yet China's official reserves barely budged. BlackRock's internal models estimate China accumulated 200 to 300 unreported tons in 2025. Why does this matter? Because when central banks buy, they're not selling. That gold disappears from the market permanently. Signal number 2, US dollar weakness incoming. The dollar index hit 108 in late 2025, its highest level in 2 years. But BlackRock's currency team expects a reversal in 2026. Why? Federal Reserve rate cuts. With the Fed expected to cut at least 3 more times, bringing rates toward 3.5 to 4%, the dollar's yield advantage over other currencies shrinks. According to a December 2025 report from Oanda, analysts are forecasting the US dollar index to drift toward the low to mid-90s by end of 2026. A falling dollar is rocket fuel for gold. Historically, a 5% drop in the dollar index corresponds to a 10 to 15% rise in gold prices. Signal number 3, geopolitical risk premium. BlackRock's geopolitical risk models currently show elevated probabilities for multiple flashpoint scenarios. Ukraine conflict escalation, Middle East instability, Taiwan tensions. Their model assigns a $200 to $400 premium to gold when these risk factors spike above historical norms. We're there now. Every time conflict probabilities rise, institutional allocators increase defensive assets, and gold is the defensive asset. Signal number 4, institutional FOMO building. Here's the shocking stat. According to BlackRock's own surveys, pension funds currently allocate only 0.5 or 1% to gold on average. Recommended allocation by most strategists, 5 to 10%. If institutional portfolios, which control $50+ trillion globally, move just 2% into gold, that's $1 trillion of demand. For context, the entire global gold market is roughly $15 trillion. A $1 trillion demand shock would send prices vertical. BlackRock sees this FOMO wave building. That's why they're positioning ahead of it. Let's talk about the math behind BlackRock's $4,200 target, because this isn't pulled from thin air. Current gold price, $3,900 per ounce. As of early January 2026, BlackRock's target, $4,200 by December 2026. Here's how they build the target. Base case scenario, $3,500. That's the inflation-adjusted currency debasement floor. With Fed cutting rates and deficits still running $1.5 trillion per year, gold should trade at $3,500 minimum, just as a dollar hedge. Add central bank demand premium, $300. With 1,000 plus tons of annual purchases becoming the new normal, supply-demand imbalance adds $300. Add geopolitical risk premium, $400. Current elevated conflict probabilities justify a $200, $400 premium. They're using $400 as base case. Total, $3,500 plus $300 plus $400 for $200. And here's the kicker. BlackRock also modeled a bull case scenario at $4,800, $5,000. How? If central bank buying exceeds 1,000 tons, hits $1,200 and $1,500, add another $300. If geopolitical situation worsens, major conflict outbreak, add another $300, $500. Suddenly, you're at $4,800, $5,000. For context, JP Morgan's latest forecast, published December 16, 2025, calls for gold to average $550 per ounce by Q4 2026, potentially reaching $5,400 by late 2027. Goldman Sachs predicts $4,900 by December 2026. Bank of America sees $5,000. So BlackRock's $4,200 target, that's actually conservative compared to other major banks. But here's the trap you need to avoid following BlackRock too late. By the time BlackRock officially announces increased gold allocations publicly, the accumulation phase is over. Look at what happened in 2020. Institutions bought gold at $1,600, $700 in March and April. Public recommendations came in May and June. Retail investors piled in at $800, $900. Gold topped at $2,060 in August. Retail bought the top. Don't be exit liquidity. If you wait for the official BlackRock research report saying upgrade gold to overweight, you'll be buying at $4,500 when institutions accumulated at $3,800. The leaked call is your edge. Use it. Now, one more thing. BlackRock wants your money in their ETFs. Why? Because they collect management fees on assets under management. The more money in their IAU Gold ETF, the more fees they collect. So understand, when they eventually do make public recommendations, they're not doing you a favor. They're driving assets into their funds. That doesn't mean don't buy gold. It means buy smart, buy early, and consider physical gold or allocated storage, not just paper ETF shares. Let's talk about why this leak probably wasn't an accident. In institutional finance, very few things leak without someone wanting them to leak. BlackRock likely understands that controlled information drips serve several purposes. 1. Gauge market reaction. See how investors respond without official commitment. 2. Create FOMO. Get smaller funds and retail moving in the right direction while BlackRock finishes accumulating. 3. Test narratives. See which messaging resonates. Is it inflation fears, geopolitical risks, or dollar collapse? Meanwhile, mainstream media will dismiss $4,200 gold as unrealistic or speculative. Same media that said $2,000 gold was impossible in 2019. Same media that called $3,000 a bubble in early 2025. They'll trot out analysts saying gold is overbought and due for correction while BlackRock quietly accumulates every dip. This is psychological warfare. The institutions play chess. Retail plays checkers. Your job? Recognize the game and position accordingly. So what happens next? Let me give you 3 scenarios with probability weights. Scenario 1, slow grind higher, 50% probability. Gold slowly climbs from $3,900 to $4,200 over the next 10-12 months. We hit $4,000 by mid-2026, then $4,200 by Q4 2026. This is the base case. Steady central bank buying, gradual Fed cuts, manageable geopolitical tensions. No panic, just relentless institutional accumulation. Scenario 2, crisis spike, 30% probability. A major geopolitical event or financial crisis triggers panic buying. Gold jumps $300, $500 in weeks, not months. We spike to $4,200, $4,500 by mid-2026, potentially overshooting to $4,800 before consolidating. This is the scenario BlackRock is positioned for with their emergency call. They want to be ahead of the stampede. Scenario 3, overshoot to 5,000 plus, 20% probability. Retail FOMO kicks in. Pension funds panic allocate. The move becomes self-reinforcing. Gold doesn't stop at $40,200. It blows through to 5,000 plus by year-end 2026. Historically, gold rallies overshoot targets when momentum gets extreme. The Hunt Brothers silver situation. In 1980, the $1,400 spike in 2011, the $2,068 top in 2020. If institutional FOMO builds, $4,200 could be just a waypoint to $5,000, $6,000. And JP Morgan's forecast of $5,005 by Q4 2026, that supports this scenario. Let's bring this home. BlackRock's sought in $10 trillion asset manager just leaked internal positioning for $48,200 gold by end of 2026. They're not speculating, they're positioning. They see three drivers: central bank buying at record levels, Fed rate cuts weakening the dollar, and geopolitical chaos adding a sustained risk premium. Their public target is $3,800 for $4,000. Their internal target is $4,200, $4,800. Why the difference? Because they're still accumulating. History shows BlackRock's emergency positioning calls precede major moves by 6 to 18 months. 2008, 2020, and now 2025, 2026. You have a narrow window. Right now, in early January 2026, gold is around $3,900. Institutions are accumulating. The public hasn't caught on yet. Here's what you need to do. 1. Track BlackRock's IAU ETF inflows. Those are reported weekly. Watch for acceleration. 2. Monitor JP Morgan, Goldman Sachs, and Bank of America public commentary. When they officially upgrade gold, that confirms institutional positioning is complete. 3. Don't chase. Scale into positions on any pullbacks. If gold dips to $3,700 or $3,800, that's institutions shaking out weak hands before the next leg. 4. Subscribe to this channel for weekly updates as this unfolds. I'll track the institutional money flows in real time. 5. Comment below. Are you positioned for $4,200 gold? What's your target? I read every comment. In my next video, I'm breaking down exactly how to buy gold like BlackRock does, allocated storage, vault options, and how to avoid the paper gold trap. That video drops in 48 hours. Remember, when giants panic into an asset, the smart money follows. The question is, will you be early or will you be exiting liquidity? I'll see you in the next one.